Hello,
All right.
everyone. My name is Natasha Hicks. I am an attorney licensed to practice here in Illinois, and I recently joined Mueller and Company in their tax department, focusing mainly on high net worth individual and trust taxation. Today, I, along with my colleague Dan Patterson, will be discussing the employee retention credit. Before we get started, I'll talk a little bit and let Dan introduce himself. So if you want to introduce yourself, Dan.
Yeah, thanks, Natasha. My name is Dan Patterson. I have been with the Client Advisory Services Department here at Mueller for a little bit over 4 years. I'm going to focus mostly on kind of talking about how you go about claiming this credit retroactively and going forward and for the first 2 quarters of 2021. But before I get into my part, Natasha will talk about kind of what the credit is and kind of a summary of how to calculate it and so on.
Okay, so feel free, you guys, to put any questions that you have in the chat, but we're going to defer to the end to answer those questions. But as we're going along, if you see something that you might want more information about, just go ahead and put those questions in the chat. So as I said before, this discussion is going to be focused on the employee retention credit, which we will sometimes refer to as the ERC. And for those of you who are not especially familiar with this, I'll start by saying that this credit was originally introduced under the CARES Act back in March of 2020. It was one of 2 incentives that Congress provided to try to encourage businesses to retain their employees during the COVID-19 crisis. Initially, there wasn't a lot of excitement about the ERC because it was kind of overshadowed by the more popular Paycheck Protection Loan Program. However, there was some new passage of the Consolidated Appropriations Act in December of 2020, and now we've got some exciting new changes to the ERC that make it available to more employers, and it provides increased benefits to those who are eligible to receive the credit. So because of the first initiation with the CARES Act in 2020, and then this update with the Consolidated Appropriations Act, we're going to break this analysis down into a few parts. First, we're going to talk about how the credit works for tax year 2020. We're going to talk about what is the employer retention credit, who may claim the ERC, and what are the benefits for claiming this credit. Then we're going to go and talk a little bit about what the changes are for 2021 in terms of qualified wages and the credit amount. And we'll talk a little bit about how this credit interacts with the PPP and some other credits allowed under the Act. And finally, Dan will wrap this up talking about how you can go about claiming the credit once you know you're eligible. Before we go into the details of eligibility, I'm going to talk a little bit about some things that were a part of the employee retention credit as it was originally enacted back in March of 2020, and that remain in effect for anyone claiming the credit in tax year 2020. So when this was originally enacted, the CARES Act said it was only available to tax-exempt entities and for-profit businesses. The CARES Act specifically excluded government entities from the pool of eligible recipients, and it barred employers from receiving both an ERC and the PPP loan program, a loan under the PPP program. And speaking of the PPP program, although this discussion will not focus on that particular part of the Act, it's really relevant because with the update of the ERC, there might be some benefits to those who received a PPP loan back in 2020. There are some updates to the wage calculations for those who might receive it, and now there might be some people who are eligible to receive both of those credits. So now let's talk a little bit about the good stuff. who is eligible to receive the employee retention credit. So whether an employer is claiming this credit for tax year 2020 or for tax year 2021, there are some hurdles that are the same. And the first is that they must qualify under one of the two options that we see in front of us. It's a two-part OR test. So you may qualify under the government shutdown test, or you might qualify under the gross receipts test. For now, I'm just going to focus on the part about the government shutdown test. The government shutdown test requires an employer to have business operations fully or partially suspended because of a government order due to COVID-19. When we look at the details for this, we'll notice that the government order does not have to be a full shutdown. It can be a partial shutdown, as long as the employer cannot continue operations in a manner comparable to before COVID-19. So if you are an employer and you run a business, your business modifications must have more than a nominal effect. If your employers or your employees are able to telework from home, then there's no real suspension. And the most important part of the government shutdown test is that if you as an employer qualify under this rule, the credit is allowed only for wages paid while the government order is in effect. So if we take a look at this slide, we have an example of how this operates. In our example, business A was ordered to shut down from March 17th, 2020 through April 17th, 2020. And after April 17th, the employer was allowed to resume business operations as usual. However, the employer remained closed through the end of April just to be safe. Since the government order was only for March 17th through April 17th, the employer may only claim the credit for wages paid during the time that there was an actual shutdown. So even though the employer paid wages for those that last 2 weeks or so after April 17th, notice that you cannot claim a credit for that time. However, if you're not able to take a ERC under this deduction, you might also be able to do it under the gross receipts test. So let's take a look at how the gross receipts test works. Go back and take a look at our rule for that. If you want to qualify under the gross receipts test, an employer must experience a more than 50% decline in gross receipts as compared to the same quarter in 2019. And once an employer reaches this required decline in receipts, he may claim a credit for every quarter until the end of quarter in which those receipts exceed 80% for the corresponding quarter in 2019. When we're looking at gross receipts, we're going to look at the sales less the returns and allowances, plus any investment income, less your adjusted basis of your assets sold. And it's the same for a tax exempt company, except we're also going to look at things such as grants, gifts, and membership dues. So let's take a look at how this works visually. This slide shows an example of qualifying under the gross receipts test. If we take a look, we can see that in the first, second, and third and fourth quarter of 2019, our employer had gross receipts of 100,000. In the first quarter, they had a decline in receipts of for 2020, but only of 21,000, which would be 21%. Since this was not a more than 50% decline in receipts, this employer is not eligible to receive the ERC for this particular quarter. But if we take a look at quarter two, this employer's receipts dropped down to 49,000. At this point, the employer is able to take a ERC for wages paid to its employees starting in the beginning of the second quarter. If we take a look at quarter 3, our receipts have now risen to $81,000. And even though this is more than 80% of what it was in 2019, the rule over here says that once an employer reaches the required decline, they can take the ERC for wages paid through the end of the quarter where they reach more than 80%. So this employer will get to take a credit all the way through the end of the third quarter. So now once we've determined that we can take this credit, the next step is to determine how much of our credit are we able to claim. If we take a look at how this works in tax year 2020, we can see that an employer may claim a credit for wages paid between March 13th and December 31st of 2020. The employer may claim a credit for 50% of up to $10,000 of qualified wages paid per employee for the entire year. And notice that this is not a 50% credit on all wages paid. The max is $10,000. So the amount of credit you can take is a maximum of $5,000 per employee for the year. And your qualified wages included are going to be all the gross wages subject to Social Security taxes and your allocable health expenses. So let's take a look at how this works visually on our next slide. In this example, we have 2 employees, and we're going to look at how the credit works when we use their wages for the first quarter and the second quarter. So our first employee is Adam. We can see that Adam was paid $15,000 in wages in the first quarter. Our wage limit for tax year 2020 is 50% of $10,000 per year. So that means that Adam is going to get 50% of $10,000, which is a $5,000 credit for wages paid during the first quarter of 2020. We'll take a look again at how this works with our second employee, who is Steve. In the first quarter, Steve was paid $6,000. He's subject to the same wage limit. So 50% of the $6,000 that he received is going to be $3,000. Now let's see how what happened in the first quarter is going to affect what happens in our second quarter if we're claiming this credit for tax year 2020. In our second quarter, Adam received wages of $8,000. But as we can see, he has already reached his max in quarter 1. So he's not going to receive a credit for the second quarter in 2020. He's going to max out at the $5,000. When we look at Steve, we see that Steve still has $4,000 of the wage limit left. So when he gets a $2,000 payment in quarter 2, he can still receive a $1,000 credit for a total of $4,000 credit that this employer receives because of Steve. So altogether, this employer is going to receive a $9,000 credit for the wages paid to these 2 employees over the first and second quarter of tax year 2020. Another item to note is that the amount of the credit that an employer may receive is going to differ depending on the number of full-time employees that the employer had in tax year 2019. So the rule is if an employer has if the employer averages 100 or fewer full-time employees in 2019, then that employer may include all wages paid to employees while the government order is in place or during the quarter that he experienced a required decline in receipts. When we're determining who full-time employees are, we're going to look at those who in 2019 averaged at least 30 hours of service per week or 130 hours of service per month. And we determine the number of full-time employees on a month-to-month basis. If you were in business the entire time in 2019, then you can just add your total full-time employees for the year and divide by 12. So let's take a look at an example of what the credit will be if our employee has less than 100 employees, our employer has less than 100 employees for the year. So employer A, who is a retail shop owner, has 80 full-time employees in 2019. The employer is forced to partially shut down his business due to COVID-19. He pays his 30 salesmen $30,000 in wages, even though they are forced to stay at home due to a government shutdown. He pays his other 50 employees $50,000 to work handling orders for curbside pickup. Since employee A has 100 full-time employees or fewer, the entire $80,000 that he pays these employees is going to be eligible for the credit. So we're going to look at this on an employee by employee basis. He has 80,000 employees that 80 employees that he paid $80,000. So assuming he paid, $1,000 a piece for each employee, this employer will be eligible for a $40,000 credit for all of the wages that he paid to his employees. Now, our next slide will take a look at how this works if you are an employer who has more than 100 full-time employees. The rule under this portion is that employers who averaged more than 100 full-time employees during 2019 may receive a credit for the wages paid to employees who are not working. So under the CARES Act, if you are claiming the employee retention credit for tax year 2020, and you have more than 100 full-time employees, or you averaged more than 100 full-time employees during tax year 2019, then you can only claim the employee retention credit for employees who are not performing services. So let's take a look at our example. In our example, our employee, Baxter Inc., a restaurant, averaged 200 full-time employees in 2019. During 2020, the restaurant is partially shut down due to COVID-19, and the employer pays its 50 servers $50,000 while they're not working and staying at home. The employer pays 150 of its cooks $150,000 to provide takeout orders. Even though this employee has paid them $200,000 in total, the employer may only claim the ERC for the $50,000 paid to servers who are not working. And this is because of this limit that says when you have more than 100 employees, you can only receive a credit for those when you pay wages to those who are not working. So as we can see, this is a big hindrance on how much an employer might be able to claim for the ERC credit if they have more than 100 employees. Fortunately for employers, in December of this past year, the Consolidated Appropriations Act updated this rule as well as a few others, and now a bit more employees are eligible to claim the ERC for tax year 2021. And as we'll see as we go through the comparison and we go through the examples, more of these employees are eligible for a larger credit because the credit limit increased per employee for the quarter instead of just for the year. In addition to that, one of the major items of the Consolidated Appropriations Act is that now those who borrowed a PPP loan back in 2020 might also be able to go back and take an ERC for that year, and they might be able to claim both of these benefits for tax year 2021. Dan will get into more of the details about that when it's his turn, but keep that on your radar because that's an exciting new update. When we take a look at this slide, we can see the changes from tax year 2020 and to tax year 2021. So one of the biggest changes that was made is that there is an increase to the amount of the credit that each employer may take in tax year 2021. So as we recall, in tax year 20, the maximum amount that any employer could claim for one employee was $5,000. But with the passage of the Consolidated Appropriations Act, now an employer may claim up to 70% of $10,000 per quarter instead of per year. For now, this act extends to June 30th, so that's the first 2 quarters. So that means that there is a max of $14,000 per employee that may be claimed. So that's a huge jump in the amount of credit that an employer can claim. In addition, the eligibility for a decline in gross receipts has changed. So in 2020, there had to be a 50% decline in gross receipts as compared to the same quarter in 2019 before this would make an employer eligible to receive this credit. However, if someone wants to claim this credit for tax year 2021, there only needs to be a 20% decline in gross receipts. And perhaps one of the bigger changes that we see coming through is that now an employer may claim all of the wages paid if they have 500 or less employees. So when we get to the next slide, we'll see that that's a significant increase of the amount of credit that might be claimed by a particular employer. This next visual shows a side-by-side of how the rules operate 2020 versus 2021. So remember in 2020, in that first quarter, our employee had a decline of 21% in gross receipts. And they were not eligible to receive the credit for 2020 because it was not a 50% decline. But when we get over to quarter one, that employer has a 21% decline in gross receipts. And because the rule is at least a 20% decline, that makes them eligible to receive the ERC for quarter one. It's the same thing for quarter two, even though there has been an increase and now there is an 81% of the 100% of the second quarter in 2019. This employer will still receive the credit through the end of the second quarter. Hopefully, if they extend this to the third and the fourth quarter, you'll see that this is going to work the same way. As long as there's a 20% decline in gross receipts, the employer can receive the ERC for that particular quarter. Looking back again at our 2 employees, Adam and Steve, we can see the big change in the amount of the credit that can be claimed depending on whether you're claiming this credit in 2020 or 2021. So remember, Adam, our first employer, he maxed out at $5,000 way back in the first quarter. And we were not able to take any of the wages that he was paid in quarter two and receive a credit. But let's take a look at how Adam fares under the new rules in tax year 2021. So under the new rules, we may now take a credit of 70% of up to $10,000 per quarter. So in this first quarter, Adam is going to get $7,000 of a credit attributable to him. And then he'll get another $7,000 attributable to him in this second quarter for a total of $14,000 that the employer may receive for just this one employee. Let's take a look at how it works for Steve. Remember, if it was tax year 2021, Steve got half of this $3,000 in the first quarter. And then there was another $2,000 the employee could receive for Steve in the second quarter. But no matter when they pay the $10,000, whether they pay it in the first quarter or whether you split it up across the other quarters, notice that you're still going to max out at 50% of $10,000 and only receive a 5,000 credit for this particular employee. Of course, this is going to change the same as it did for Adam when we get to tax year 2021. So for these wages, Adam is going to get attributable to him 70% of $6,000, which is going to be $4,200. And then for the second quarter, he's also going to get 70% of $10,000 for a total of $11,200. So when we take a look at what the totals are here, we can see that this is really a significant increase in the amount of money or amount of credit that can be received for each one of these employees to our employer. Before I wrap things up and give it to Dan, I want to talk about how this credit interacts with some other credits and talk a little bit about some things that we need to kind of pay attention to if you're planning on, if you're an employer and you're planning to claim this credit for tax year 2021. So the first thing is that the IRS is kind of really trying to guard against double dipping. So you, as an employer, you can claim the family and medical leave credits, you can claim the research and development credits, and you can claim the work opportunity credit, but you just can't claim them on the same wages that you're using to claim the ERC. It's kind of the same rule, you know, no double dipping. But I think one of the bigger things to be aware of is how the aggregation rules work for the ERC. Under the aggregation rules, all related parties are treated as a single group for all aspects of the ERC. So that means the parent sub companies, brother and sister, combined group operations, each one of these is treated as a single group. Same thing when we have related partnerships, trusts, and estates. Now, what this means that it can work either way. So it can be a positive thing because if you're all grouped together for the government shutdown portion, then that means that if one of these businesses is shut down due to government order, then all of these businesses are eligible for the ERC. But it can be a little bit more damaging when you're analyzing this under the gross receipts test and you're trying to determine your full-time employees back in 2019. So if you have several businesses and they might operate differently depending on which arm or which branch they are, they're going to be grouped together under the aggregation rules for the ERC. And so that may make it quicker for you to reach that 500 or fewer full-time employees, and then that's going to limit the amount of credit that you're going to be able to receive. This is just a little bit of an analysis of things that changed. You guys can go back and look at that later on when you're looking over the slides. But finally, a few final thoughts on the ERC. If you are an employer and you want to determine or you're thinking about claiming the ERC, you should ask yourself these questions. Did you experience a sharp decline in receipts or have a shutdown because of a government order? If you did, then how many average full-time employees did you have for 2019? Because that's going to affect the amount of your credit. Once you determine the amount of eligible wages you can use for your credit, then you go on to the final stage of determining how you plan to take the credit. And at this point, I'm kind of finished with my portion. I know you guys have some questions in the chat box, so we'll get to those after Dan talks a little bit, and he's going to talk about how you can take the credit once you determine that you're eligible. I'm going to give things over to Dan and let him talk a little bit.
All right, great job, Natasha. Thank you very much. So we get control here. Oh, okay, cool. So yeah, Natasha did a great job talking about, you know, what this credit is, you know, the differences between the 2020 eligibility and the 2021 eligibility, and how you go about seeing, you know, if you are going to be eligible and if you should think about retroactively going back and claiming this credit and going forward claiming this credit for the first 2 quarters of 2021. So what I want to focus on is after you figured out that you are eligible and that you should go either back and claim this credit or you should claim it going forward in 2021, how are you going to go about doing that? And so let's start here. It's going to involve this 941. So beginning second quarter in 2020, you can report those total qualified wages and some related health insurance costs for each quarter on that quarterly tax form, the form 941. I'll get into some specifics of where you're going to be filling out some of those items and how you go about filling those out. Also, in 2021 and how it was when it first came out was you could reduce your deposits that you made in anticipation of getting this credit. And so I can show you where, going forward in 2021, where you're going to want to report those and how it's going to be treated. You can retain those payroll tax deposits rather than depositing them with the IRS, and that includes your federal income taxes withheld and your Social Security and Medicare taxes for the employee and the employer. And then also, if you're already reducing your tax deposits to the IRS and it's still not going to be enough for the anticipated credit that you're going to get, you're going to want to fill out that form 7200. And so that will just be like an advance payment from the IRS to give you that credit before you would end up filing that, which would be with your 941 reports, which would be at the end of each quarter. So in 2021, you'd be filling that out before April 30th for first quarter of 2021. And so there is an interaction between this ERC and the PPP loan. And like Natasha was saying before, they really don't want you double dipping in any case. If you used the Payroll Protection Program loan funds to pay for wages during 2020 and going forward in 2021 with the second round, they don't want you using those wages to count towards that ERC and getting a refundable credit on those wages. And so, but they did say that if you applied for the PPP loan in 2020 and you repaid it by May 18th of 2020, they're just going to treat it as though you never received a loan under the PPP. And then also, one thing to note here is that there's really not a concrete way to calculate these wages so far and the overlap and how it's going to be treated. It's going to be a lot of paperwork, we know that, but at this point in time, there isn't a concrete way to figure out how you're going to use those funds between the PPP and the ERC and to show that you're not double dipping in each sense. If you took out a certain amount for your PPP loan and you had way more wages than the money that you took out, you're probably going to be fine. But in a case where you're just using enough over your covered period, it might be a little tricky to figure out what wages are going to be qualified for the PPP loan and what wages are going to be qualified for that ERC. So one thing we do know is that the AICPA has issued a letter to the Treasury and the IRS asking for further guidance on this. So we're hoping that it's got to be before the first quarter returns are due for 2021 that there's a little bit more of a proper guidance on how to figure out this credit when you have in fact taken out a PPP loan and you're even applying for the second round even. So if you do go through and you realize that you do qualify for the credit in 2020, you can retroactively go back and claim this credit. And what that involves, they did make it so that you could have put a whole credit amount on your fourth quarter 2020 payroll tax returns, but it's a little too late for that now since they were due by the first. But you can go back and amend those returns in 2020. Any of them that you qualified, it would be the 941 return in 2020. And then I did a little bit of research onto some and talked with some payroll companies to see what their if they would assist in this process, and some of them will, usually for a fee, usually like if they open back up 2020, they might charge you for something, and then amending each return, they would charge you for something as well. I spoke with ADP, and they actually have a team that will help assist with the credit amount and the amendment process, and they will actually send the returns in for you, which is nice. But a lot of other companies want you to do it all yourself. You can, maybe they might file the form for you, but you have to do all the calculations yourself. So one thing we would recommend is reaching out to your payroll company to see if they can assist in the process in any way as well. Along with Mueller, you can also reach out to us, and we can help, see if you're eligible. We can help see what your credit amount might be. But once you figure out that you did have a credit that you can claim back in 2020, you're going to want to fill out this 941X form. And so I just kind of did some screenshots of the important pieces that we're going to need here. And the first part is really just asking if you want to claim for a credit or for an actual refund, and just kind of a little questionnaire saying how you treated your deposits throughout that quarter that you're trying to amend. And but the one we really want to focus on here is number 18, this non-refundable portion of the employee retention credit. This is basically a copy of your 941 form, and in this left column right here, you're going to put all the corrected amounts, and then you're going to put in this column 2 here the amount originally reported, and then it's just going to be the difference here, and you're just going to be totaling it up as you go along here to see what your credit or is going to be. So in our case, we would put, since it is a credit, we would put a negative amount in this total corrected amount. And then it would obviously be a 0 if you weren't claiming it in the first place. And then you'd have this negative amount right here. And so when we go to the next page here, where it's asking for kind of the totals of everything, you would fill out your refundable portion, which I will talk about kind of how to calculate that piece in a second here. You would put that negative amount there too, and then you'd have that, and then they would ask for the total here, and since it would be a negative amount, that's going to be an amount that's going to be refunded for you. And so you would just submit this form for every quarter that you would qualify to claim that credit and that you are asking for. And these forms cannot be submitted online, so they would have to be mailed in. If you do, like I said, if you work with a payroll company, a lot of times they will send them in on your behalf, but these will have to be mailed in. And so I talked about kind of how to go back and make an amendment on a payroll tax return for every quarter that you qualified in 2020. But going forward in 2021, you're going to continue filling out your 941s, but you're going to add this new piece for this ERC. So I did look at a draft that they had for the 941s that they released for 2021, and I didn't really see any significant changes. So I did just kind of crop out pieces of the 2020 941s because there's really not a difference at this point in time. They could, when they release the final copy of the 941s, it could be different, but working with what the information we have now, I want to focus on once you get to the number 11, there's 11, A, B, C, and D, and this is where it starts getting into the credit pieces. And so you're going to start putting down the non-refundable portions of each credits you have here in 11B and 11C, which we have this non-refundable portion of our employee retention credit. And it says from Worksheet 1, and I'm going to mention Worksheet 1 a little bit just because it is a sheet that you can submit it, but it is not necessary to submit it with the 941, but it is kind of a tool that you can use to help you calculate out what your credit's going to be and what portion of it's going to be non-refundable and what portion of it's going to be refundable. And so once you do fill out this Worksheet 1 or you do your own calculation on here, you're going to put that amount in that 11C, and then once we hit this next portion of the 941, it's basically just going to have you totaling up everything. You're going to have your total non-refundable credits, which is just the totals of all those 11 numbers, that 11 A, B, and C. And then you're going to have your total taxes after adjustments in your refundable credits. You're going to basically take these non-refundable credits and minus them out from the tax that you owed for that quarter. And then once you get to this 13D, that is where you're going to put your refundable portion from that worksheet one again, or your own calculation. And so you're going to add all these parts up to get this total deposits. After you minus out in this 13F box right here, any portions that, if you were filling out these 7200 forms for these advances and you were basically withholding your tax deposits from the IRS, you would put these amounts here because that needs to be subtracted out. And then once you get this final 13G number, of which is your total deposits, your deferrals, and your refundable credits, and then, like I said, less any of your advances that you got, you're going to figure out your overpayment. And since we already deducted out those non-refundable credits, you can either get a refund or you can apply these to the next return. Okay. And then this third piece here, it's just going to ask you for your qualified wages. And so you're just going to go down the line here and you're going to put your qualified wages for your employee retention credit, which, like I said, we're trying to figure out what is going to be the difference between the qualified wages for the retention credit and what is going to be the qualified wages for the PPP loan, and how you are going to differentiate between the two. So it is still kind of up in the air right now. You would put any qualified health expenses here, any credits for other items, and that would be basically what you have to do for this 941 return going forward in 2021. Like I said, there's really not any differences so far between the 2021 version and the 2020 version. But there is these new items that you are going to have to be filling out if you are going to try to claim this ERC. So I talked about this worksheet one a little bit, and for purposes of the ERC, you can use this worksheet for the other credits as well, but I'm going to focus on the ERC for right now, especially with our kind of limited time here. I am going to start going a little faster here. Basically, this step one here is just figuring out what pieces of the credit you are going to want to claim. It's going to have you write down your Social Security taxes amounts, and it's basically going to have you figure out any other pieces you're using of credits. You're going to write down your employee share of your Social Security tax, and these are all items you can already fill out from your Form 941 when you're filling this out. And it's going to get you down here your total non-refundable credits that's already used against your share of Social Security taxes once you add these lines up from your 941 numbers. And then it's going to give you your amount that's remaining, which you're going to use to go down to step 3 on this worksheet, which is where kind of the bread and butter is here when you're figuring your employee retention credit. You're going to have your qualified wages, which is that part from the 941, that line 21, which I talked about prior. You're going to have your qualified health plan expenses that you're going to use for this, and you're going to add them up here, and this is going to be your total retention credit, the 50% of that. Then you're going to bring over from that step 1 that amount of the employee share of the Social Security taxes. And then any amount of the non-refundable portion of the credit for qualified sick and family leave wages in step 2 if you needed to fill that out, which you probably wouldn't. And then You're going to subtract that left line F from FE, and then you're going to get your non-refundable portion, which is going to be the smaller of the retention credit amount, or this amount right here in 3G. And then once you take this line 3H of your non-refundable and you subtract it from your 3D, that's going to be your refundable portion. So this worksheet is just kind of a tool that you can use to help you as you go along throughout this process of figuring out what your credit's going to be and how you're going to calculate it for 2020 and going forward in 2021. The last thing I kind of want to touch on here is this Form 7200, which Natasha mentioned a little bit. And, basically, if the reductions that you're making in your deposits are not enough to cover the amount of credit that you're anticipating, then you're gonna want to fill this out. You can fill it out multiple times a quarter. You can even fill it out every payroll if you wanted to. But this is basically just an advance of this credit because you're expecting more of this credit and you're already withholding your deposits. So the only way we would really recommend you doing this is if you needed this money right away to be able to still make payroll. Besides that, you will be getting your amounts of credits by filing your 941 quarterly. So basically for this line 1, they want you to put your total employee retention credit for the quarter, which is just going to be your 50% of your qualified wages. And then you would put any amounts that you had for the sick leave wages eligible or the family wages eligible, and you'd put your total right here. And then you'd put down here your reduction in your deposits that you've had already, and then any advances and credits that you had here that you had prior to this. So if you were filling them out, weekly or biweekly, you would put those in that amount there, and then you'd add those up. And then if you have a positive amount, then that would just be your advances that you would be eligible for and that you would get. I'm not exactly sure on the time frame of how quick you get these advances, but I would suspect it would be faster than a quarterly filing for the whole amount of the credit instead of just the advance. But like I said, you can reduce your tax deposits in anticipation of the credit. And like I said, this is going to have a lot of paperwork involved with it, and you're going to want to keep a lot of this paperwork. So they put out what records the IRS said what records they want you to retain for the next 4 years when you're thinking about getting this credit and you're making claims for this credit. They want documentation showing your eligibility for the retention credit based on suspension of operations or a significant decline in gross receipts. They want documentation showing how you figured the amount of the employee retention credit. So that worksheet 1 that I mentioned, that would be beneficial to have when you're going through and figuring out what records you want to keep. Then they want documentation showing how you figured the amount of the qualified health plan expenses that you allocated to wages. They want records of your FTEs, and then including how you arrived at your average number, which hopefully your payroll companies can provide you with those reports. They're kind of jumping more on board, and I've seen some nice reports coming out of some payroll companies. And then you want to retain any copies of your completed Form 7200 that you filed with the IRS. And so you want to be sure that you keep everything you can and you document everything so that if there's any question of what you spent your qualified wages on, or how much you were getting with these 7200 forms, you have this documentation. So just keep everything you can is basically the advice that we have here. And that's really all I had to touch on for this presentation here. Myself and Natasha are available. You can always reach out to us with further questions that you have, or any representative that you have at Mueller, and we can assist in any way we can as far as helping you figure out how much of the credit you qualify for, and helping you through the process of amending these returns or going forward with your payroll returns. So, and I think, Natasha, you said we had some questions in the chat.
I do see some questions.
We got about 10 minutes here, so hopefully we can answer some questions if anybody has it. Please feel free to keep typing your questions into the chat.
I have a question right here. It says, how do emergency sick leave wages affect these computations?
Emergency sick leave wages affect these computations. So if you have emergency sick leave wages, you're gonna calculate those the way you normally would, except you just can't use them to calculate the ERC. So any ERC wages that you're going to use, you have to set those aside from other wages that you're going to use to calculate other credits.
Okay, I have another question. For a non-for-profit that was not able to hold any live events due to the government shutdowns, however, employees did work remotely at home, does this meet the first qualification of closure?
Well, you know, the rule is, were you able to operate your business comparable in 2020 to what it was in 2019? And so, you know, if those things are a part of what you regularly do to run your business in 2019, then it might qualify you to receive the ERC. It might be seen as sort of a partial shutdown. Now, note that if you were able to, you know, maybe have those online, you know, that's a gray area. I haven't seen a lot of information or a lot of guidance on that, but it could be worth an argument. So I'd have to do a little bit more research. I can kind of get back with you guys on that one.
Okay, another question we have is, aggregation was muddy for foreign-owned subsidiaries. Is this more clear under ERC with respect to aggregation slides?
I'm not understanding this question. Can you say it again?
Of course. Aggregation was muddy for foreign-owned subsidiaries. Is this more clear under ERC with respect to the aggregation slides?
Oh, foreign. So are you asking that, are your foreign owned subsidiaries aggregated? If that's what you're asking, then it will be. I know that for domestic companies, you're going to be aggregated because you would be considered a parent-sub relationship. And it seems that would also work for your foreign-owned subsidiaries. Any questions that I can't get through fully here, just make sure, as long as they're in the chat box, I'll get back with you guys and give you a little bit further explanation on those.
And I do want to piggyback off of that, Natasha. There are questions that came in asking if the handouts will be made available or the slides made available. And yes, this presentation was recorded, and I will make sure that all attendees get the recording and the slides as well. And then I'll also provide Natasha and Dan's contact information, so if you do have questions, feel free to reach out to them. I do have a couple more questions in here. There's one that says, is the ERC credit included in taxable income? Oh, include. Oh no, I don't think I know what this word is. I'll have Natasha address that one at the end. I am so sorry. The next question would be, should investment earnings, realized and unrealized, be included in the gross receipt figure?
It's just your realized investment earnings that are going to be included in that figure.
Okay, and then it was kind of a piggyback. Actually, I'm going to forego that one. I think this one was towards Dan. It says, interesting, we contacted ADP and were informed that they would not assist in calculating the ERC credits. Do you know what the specific team was called at ADP?
I do not know what the specific team was called. I just reached out to our representative and they said that they would be in assistance. It's possible, sure they probably don't help actually calculate out the credit, but they would help through the amendment process, is probably what they meant by that. I can look more into that to see what exactly ADP will do, because they've been pretty good with the PPP loan process as well, kind of helping out and getting reports for that. I can look a little more into it to see what the team will actually do. But I was told that they're in the process, at least, of forming a team to handle these cases, since it's very new and it's probably going to be a lot of work for payroll companies.
And then I had a follow-up to that. We were told the same thing from ADP, and then I would like to rephrase, as I did not get a clear answer. With regard to FTE qualification, do we need to include the headcount for subsidiaries outside the U.S.? So Natasha, I think that was to your response.
Can you repeat that again?
Of course. I would like to rephrase, as I did not get a clear answer. With regard to FTE qualifications, do we need to include the headcount for subsidiaries outside the U.S.?
You know, I will have to do a little bit more research on that one and give you an answer, because I don't have one right now, right off the top of my head.
And this is Chris. I'm just chiming in on that one. I know, so what they're talking about is under the PPP, the SBA, we had to use those affiliation rules, which brought in the foreign companies. It was an SBA rule. I'm not sure if the ERC uses the exact same rules for affiliation, but that was the reason from the PPP is because of the SBA requirement.
Thanks, Chris.
Yeah, thanks, Chris. And as far as ADP, I'll reach back out to them to see more specifically what they can do to assist with the process, and I can get back to everyone.
Awesome. And I think we have one last question. Would this credit affect the wages that could be used for section 199A?
So we use for Robin, can you answer that one for us?
Yeah, that's a good question.
Are you on
Sure.
still?
So the wages are still taxable to the employees, even though they're eligible for a credit from the employer. And so those will be reported in box 1, 2, and 3 as taxable wages to the employee, which means that with the way the 199A regs are written, you're pulling those numbers right off of that W-2. Now, it's silent. It doesn't specifically say you can do it, but there's also nothing that says you can't do it. So being that these wages will be reported on the W-2, you could take the position that they are includable as wages for the 199A deduction.
I have one more comment I want to just address is, so everyone that has a PPP loan that's looking back for an ERC, definitely do your eligibility, see if it even applies to you and you're able to get the credit. After that, we'll have to wait until we get more guidance from the IRS on how the two programs work. So unfortunately, there's nothing exactly as Dan said, there's nothing out there yet, and we're still waiting for guidance on that. So first step now, just figure out if you're eligible and then wait, and then we'll provide additional details when we understand what the guidance is and what the IRS requires.
Thanks, Chris.
So I think that was our last question. Natasha or Dan, do you have any final words?
No, I don't. Just thank you guys for attending. It was really great talking about this information, and have a nice rest of your afternoon.
Yeah, thank you, everybody. And please feel free to reach out to anybody at Mueller, but you can also reach out to Natasha and myself in regards to any additional questions going forward.
Absolutely. Thank you so much. We really appreciate you attending the webinar.